This is level 2 of the CFA program, the topic on equity valuation and the reading on residual income valuation. Most of the readings in the CFA program can be consumed on a standalone basis. I believe this reading, residual income valuation, is best learned in the context of what we've done in the previous 2 readings. Remember, we had a really good reading on the Myron-Gordon dividend growth model, in which we computed the value of a company based on the present value of dividends. And we relied on things like growth rates and required returns on equity and terminal value. We did 1 and 2 and 3 and 10 and 50 stage models. Of course, we never got up to 50 stages, but you could probably theoretically come up with one of those in your brain. And then we asked the question, hey, what if a firm doesn't pay dividends? And that was pretty much the focus of the next reading on free cash flows. And so essentially all we did was substitute free cash flows in the numerator for dividends, and then we computed the value of a firm. But once again, we had a great reliance on things like growth rates and terminal value. So what we're doing in this reading is taking a step, kind of a step sideways. Some might think it's a step forward. It's clearly not a step backwards. But what we're doing is asking the question, all right, we've done this present value stuff based on a promise made by the executives. Remember, the executives borrow capital from the shareholders, and they say something like, look, we're going to do our best to invest in positive net present value projects, and you can have whatever's left over, whether it's dividends or free cash flow. So now we're taking a step kind of sideways and saying something like, you know what? Let's go way, way back in time and let's be a little bit more basic. Let's ask ourselves the question, what is the value of a firm based on its ability to generate economic profit? And economic profit is defined, pretty loosely as something like revenues minus explicit costs minus implicit costs. And that's what we're doing here. We're still going to do present value, and we're still going to rely on some of the big assumptions that we made in the previous 2 readings. But to fully understand residual income valuation, we need to make sure we understand on how it builds on the dividend models and the free cash flow models. So thank you for putting up with me there for a few minutes by way of an introduction. But let's look at some of these learning outcome statements. Residual income, economic value added, market value added. And then we're going to have to do some calculations just like we did before. We're going to have to explain some fundamentals just like we did before. We'll go ahead and look at some multiples. In this case, it'll be a price to book ratio. And then look at that second to the last one, multi-stage residual income model. So we'll do all that stuff that we've done before, and then look at the second one there. I think this is an important one. Compare residual income models to dividend discount and free cash flow models. I just pretty much did that for you here in my introduction. And then, like the Institute does on many readings, they ask us to identify strengths and weaknesses, and then look at that last one. And that's essentially what our job is as good financial analysts. We have all this information, we have all this data, we process it into our brains, and we say, you know what, that stock is undervalued or overvalued or fairly valued. All right, let's get right to it here. Calculate and interpret some of these economic profits. So look at that first one, equivalent to economic profit. That's what I just said before. So 2 simple but important equations here. So what are we going to do to compute residual income? Let's start with net income. Let's subtract out that equity charge. That's kind of like the implicit cost, which, if you remember from our economics days, is also includes an opportunity cost. And that's going to get us residual income. Now we can do it in a different manner. We can start with net operating profit after taxes. We can subtract out a capital charge. So look at those bottom 2 circles there. On the left-hand equation, we have an equity charge, which is a charge that we impose on our shareholders, or rather are imposed on us by our shareholders. So that's the bottom right of the balance sheet. Capital charge is the entire right-hand side of the balance sheet. Let's go ahead and take a look at a pretty interesting example here. Calculating residual income. So look at the box on the left, the orange box. So this is what's given to us in the question stem. Assets, operating income, a couple of ratios, a couple of percentages. So our task is to calculate residual income. So what we're going to do, let me just quickly go back here. And let's start with the left-hand equation. So let's go ahead and figure out what net income is. All right, so we start with EBIT. 312, that's given to us, less interest expense, that's going to turn out to be 11,700. A couple of assumptions here go into that calculation. Notice the debt to total capital ratio there, 50%. So we have total assets of 390. So that must mean we have, what is that, 195 of debt, 195 of equity. So if you multiply that by the 6%, I think you'll get the $11,700. That cost of debt there, and that's before tax. So make sure you consider that 30% tax rate when you do the calculations. We're just assuming that these bonds are selling at par value, right? So coupon rate, 6%. All right, that gets us to some kind of pre-tax income. And then we take out 30% of that, right? So there's net income, 210, 210. So we have the first component back there, net income. So let's take out the equity charge. So there's the 195,000, and we're going to multiply that by our cost of equity of 9%. That gets us to the 17,550. And that will, if you subtract that from net income, you get residual income of 192,660. And think of that as an economic profit. Think of it as revenues minus explicit costs, which we've done in that middle column there, right? To get EBIT, we took revenues and then we subtracted out things like, cost of goods sold and all that other stuff that goes in there. Then we took out interest, then we took out taxes. So we have net income minus the equity charge. So there's economic profit. Now, if we want to quickly do this over here on the right-hand side, let's start with a NOPAT. So there we go. Let's figure that out. So we'll go with EBIT, multiply that by 1 minus the tax rate. That gets us to the 218. And then the capital charge, remember, we've got 390 worth of total assets. So we've got 390 worth of debt and equity. And so we're going to multiply that by the weighted average cost of capital. And that's what I have in the brackets there. 6% times 1 minus the 30% times our 50%, right? Debt, that's the proportion of debt, and then 9 times that 50%. So that gets us 25,740. Subtract that from the NOPAT, you get the same 192,660. So these two equations here are equivalent. And actually, if you kind of take a step back and say to yourselves, all right, I don't really want to think like an accountant. I don't want to think like a financial analyst. Let me think like I'm a math major, a senior math major. And if you take a step back and, kind of don't blink and let your eyes kind of freeze, you can see that those two equations are pretty much identical. What we're doing is just, doing some multiplication before or multiplication after, and you come up with that same 192,660. Those of you who are super at math will have gotten that without me prompting you. Those of you like me who struggle and, have to work hard at math, maybe the not blinking, maybe that advice helps. All right, how about economic value added and market value added? Well, let's skip down to the bottom, market value added. I mean, this is something that we know from our very first days of Modigliani and Miller. What we're going to do is take the market value of the company. So this is what shows up on the floor of the New York Stock Exchange and the floor of the bond exchange, right? Total market value. And then we're going to subtract out the accounting book value of total capital because, let's suppose market value is 100 and the bondholders and the shareholders have provided us with 20, right? So we started with 20, we ended up with 80. I'm sorry, what did I say? 100. We ended up with 100, and that gets us with 80 of a market value added. And so look at that bottom part of the lower grade box. Market value of the company equals market value of equity and market value of debt Who taught us that? Modigliani and Miller all the way back in 1958. All right, let's skip up to economic value added. If you look at that equation up at the top, that looks an awful lot like something that we just did. Of course, that's what it is. But let's go ahead and focus on the interpret part. So positive EVA management is adding value. Negative EVA management is subtracting value. Oh my gosh, that makes a lot of sense. Remember what I told you here. How about this for linking this LOS back to an LOS that we did hundreds of years ago? What do we say? The job of the board of directors is to hire and fire executives. Well, one way for the board to evaluate the performance of the executives is through this economic value added. And we can say something like, if we're the board and we have a couple of executives who are not adding value, we can legitimately say to these individuals, hey, you guys stink. Either fix it or we're going to replace you. Here's a super quick example. Boy, it'd be awesome if you got this on the exam. Couple of variables that would be given to you in the question stem. Go ahead and compute EVA and MVA. So we'll take that NOPAT and we'll subtract out these implicit costs, right? What do we call this? The equity charge. So the capital charge. So 10% times the 19,250. Let me just repeat that. That's the total capital charge. So that gets you a minus number there. So that doesn't sound like we're adding any value at all. Market value, we'll just take, well, what are we given up there? Number of outstanding shares, 550 times market price, 35. So that gets us whatever that number is. And we add the 5,500 of market value of debt. That gets us 24,750. And so we can subtract the 19,250 to get market value added of 5,500. Now, I like this illustration here because this is really a great series of exam questions, at least on a potential basis. Describe the uses of residual income models. So this is what we talked about in the beginning, right? Valuing individual stocks. And then, of course, you can throw in a whole bunch of other stuff, including equity indexes in there. So that's kind of like the primary use as good financial analysts. And as we'll see in the very last slide in this slide deck, not only are we valuing individual stocks and equity indexes, but then we're going to use this residual income model to determine whether or not a stock or an index or a benchmark or anything else we want to value is under or over or fairly valued. So that's probably one that's the primary use of residual income models. However, there are other ones. I don't really want to call these secondary because look, the LOSs describe the uses of these models. So you have to know all of these uses. But let's skip down to the bottom right. I like that determining executive compensation one. This is what I was just talking about just a few moments ago. Of course, the compensation committee on the board determines that executive compensation. And so this is a good way to say to the rest of the board and then to the bondholders and the shareholders, they say, all right, look, this executive, he or she is super talented, right? He or she has all this great background and training and skill set. And then, hey, look, over the last year or last 5 years, this particular executive was responsible for all of this stuff, economic value, this added this big, market value added this big. Let's use this model to determine executive compensation. I love that reason. And then piggybacking on that reason, look over to the left, measuring internal corporate performance. Boy, this is a good one. I'm in favor of coming up with all sorts of metrics to evaluate performance. I mean, what have we learned so far? I mean, we can do return on assets, right? We did that in 3rd grade. We can do PE ratios. We did that in 6th grade. But we can come up with our own series of metrics based on these residual income models to evaluate individuals and groups of individuals. Man, what a great way to evaluate a team, right? So you have a team. Let's suppose that this team is responsible for coming up with a new product line for a company like, oh, let me just pick one out of the air, like Malibu Boats, right? So Malibu Boats, maybe Malibu Boats wants to do golf carts. So we assign this to a team and they come up with this model, positive net present value and all this stuff. Well, we can use this residual income model to evaluate internal corporate performance. And then let's go ahead and just put out our umbrella here under that top right one, measuring goodwill impairment. Impairment is never a good idea, right? We're never happy when we impair the value of our assets, but these models are pretty good in determining how the value of goodwill has fallen over time. This LOS asks us to calculate, which we love calculations, right? Intrinsic value using this model. All right, so what we're going to do is we're going to do something like estimate future cash flows. What did we do a couple of readings ago? We estimated those future dividends. What did we do in the last reading? We estimated free cash flow. Remember all that free cash flow to equity, free cash flow to the firm. And now we're going to do the same thing. But in this case, we're going to estimate residual income. And then look at the last part of that LOS, other present value model. So we're going to still stay true to our belief in the simple fact that value today is the present value of something that you expect to get in the future. And that's something that you expect to get in the future now is this economic profit, this residual income model. So look at our circles down there that we have in the bottom. We're going to start with earnings per share. So what is earnings per share? Earnings per share is something like revenues minus all of the explicit costs. And then we're going to subtract out these implicit, these opportunity costs, or we could look at it as something like, look, the shareholders say to us as executives, look, you can have our $100, but by golly, you better pay us 10%. So there's the required return on equity times the beginning book value per share. So there's a really good way to estimate, to forecast residual income based on what I said to you early, right? Explicit costs and implicit costs. All right, so let's take a look at an example here. Just skip to the very middle, right above that lower grade block. Let's determine residual income for the next 3 years. So that's going to be an important assumption here as we move through this part of the slide deck. All right, what are we given in this problem? Year 1, 2, and 3 earnings, and then years 1, 2, and 3 dividends. So notice that the dividends make up a large chunk of those earnings, right? So 225 out of 325, 3 out of 4, 3. All right, so everybody get that. So we're paying out lots and lots of dividends. We'll start with book value of $9 and a required return on equity of 8%. All right, so let's go ahead and compute that charge for equity capital. All we're going to do is take that required return on equity of 8% times the book value at year 0, and we get 72 cents. And so all we're going to do to compute residual income is take the difference between the two. So 325 minus the 72 cents. Remember that 325, that includes the explicit costs. Minus the 72 of an equity charge, that gets us to residual income, time period 1, of 253. And so the question then asks us to continue to do this for the next couple of years. So we'll have to first compute that beginning book value at the end of year 1 or the beginning of year 2. Now remember, back here we were given that $9, right? So here we have to calculate it. So we'll start with the $9, add the 325 in earnings, and then subtract out the 225 in dividends. So think about that as, this is the bottom right-hand portion of the balance sheet. This is like the executives receive capital from the shareholders and they do something with it. And then that something with it then gets paid out as dividends. So we have the 9 plus the 325 minus the 225. So that gets us 10 for that book value beginning of year 2, times that by the 8%. And boy, here's another limiting assumption. We're assuming that required return on equity is 8% through this 3-year period. So that gets us 80 cents. So $4 of earnings minus the 80 cents, that's $3.20. And then I'll quickly just go through this next slide here for the 3rd year. So the 10 plus the 4 minus the 3, that gets us 11 times 8%. So you can see 462. So let me just quickly go back here. So what's the question? Estimate or forecast residual income for the next 3 years. We come up with 253, 320, and 462. Now let's go ahead and say to ourselves, all right, let me just go back here quickly. We've estimated those 3 residual incomes for the next 3 years. Well, the next step, of course, is let's go ahead and compute present value. So here's our model up there at the top. So the value of the firm today is equal to beginning book value plus the present value of all of those residual incomes. And notice to the left of that second equal sign, we've got a big old sigma there. So t equals 1 all the way out to infinity. Now, what did we do in this previous example? We stopped at year 3. But we could there's nothing stopping us from doing year 4 and 5 and 10 and 50 and 100 and 1,000 and 1,000,000, right? There's nothing stopping us. Well, what we're going to do at some point is we're going to use all that stuff that Myron Gordon taught us a couple of readings ago, and we're going to compute some kind of a terminal value so that we don't have to go all the way out to year 100 and 1,000 and 1,000,000. And so that's what we're doing there when we divide by 1 plus r raised to the t all the way to infinity. And then I'll show you a shortcut here in just a little bit. Now notice that what we've done is we put in bold the earnings per share in times t minus required return times last time book value. And that's just, let me go back here. Where was that? That's just that equation right there. So we substituted the right-hand side of the equal sign for the left-hand side of the equal sign, and that should be an obvious one there. So let's go ahead and compute this present value. Skip to the middle part right under that last arrow point. Assume that this firm ceases operations in 3 years. All right, so we're going to somehow liquidate after 3 years. So this sounds like a great exam question because, look, the Institute is not going to ask you to compute the present value for the next 29 years. It's got to give you some kind of a reasonable time frame to solve this problem. So, boy, there we go. There's our residual incomes that we computed earlier, 253, 320, and 462. So really, we just take the present value of those, 1775. And I want to alert you to that 1775. Put that in the back of your memory because we're going to look at that number here in just a little bit. Now, what the reading does for us in the subsequent sections is lots and lots of algebra with some cross multiplication and some substitution, and you can come up with a different version of the equation for residual income using return on equity. And notice in parentheses there that residual income is return on equity minus the required return on equity, and that's multiplied by some book value. So you can substitute that in to get value just like we did there. But let me go ahead and just remind you that that return on equity, net income over total equity, that's kind of an historical look at the performance of the income statement, right? Net income is at the bottom of the income statement in relation to what went on over in the bottom right-hand side of the balance sheet, right? Total equity. And we're subtracting the required return on equity. And remember, that's the number, that's the finger-wagging number that the shareholders say to the executives, hey, look, we're providing you with all this money, all this capital, you better earn 10% or you better earn 15%. Or else the shareholders are going to say something like, if we don't like this, then we're going to go over into the corner and hold our breath until our faces turn different colors. Now, of course, shareholders don't do that. They go to the New York Stock Exchange and they sell, sell, sell. So to avoid that, what we want to do, we want to make sure that that historical stuff is greater than the expectations and the finger wagging from the shareholders, because what we want the shareholders to provide us with 10, and we want to turn that 10 into 1,000, right? So that's what return on equity does for us. And that's what this slide is all about here. So let's go ahead and talk about this for just a little bit. Let me read those first teardrop points to you. Fundamental drivers of residual income can be identified. All right, so what did I say to you earlier in this slide deck? We're going to make assumptions about growth rates, right? It has to be a constant growth rate. We're going to make assumptions about dividends, and we're going to make assumptions about earnings. And so we can do some of that algebra that's shown to you in the reading, which you don't need to know, but you need to memorize this formula here, where we're taking the difference between return on equity and that required return times, and we've got book value there in the numerator and R minus G. You should be saying to yourself, wait a minute, Jim, I know what this model is. This is really just the Myron-Gordon growth model, in which we're substituting something in for those dividends. And that's exactly right. So look at the purple box point there. If ROE is greater than the return on equity, then residual income will be positive. Okay, that's another one. Okay, McFly, hello McFly, we know that one. But here's the important point here. The justified market to book ratio will be greater than 1. So that's probably really important. And then we go down and do the rest of these things. So if they're equal to each other, then that market to book ratio is going to be 1, and then less than, of course, right? So look at that second to last circle point. Additional value generated by the firm's ability to produce returns in excess of the cost of equity. Oh my goodness gracious. This goes back to Modigliani and Miller in 1958. We're saying what? Modigliani and Miller tells us that the value of the firm is based on the quality of the assets, right? That was their general term way back thousands of years ago. Well, now this residual income model has evolved. Can I use that word evolved to say almost the exact same thing, but now we're calling it producing returns in excess of the cost of equity. And this goes back to the finger wagging. Oh my gosh, do I need to read that bottom circle point to you? Present value of the firm's expected economic profits. So before we move on, let's just take a deep breath like I did and say, all right, this is super cool stuff. We did lots of good stuff with Myron-Gordon and dividends, but we felt a little bit wanting in that model because it relied on dividend-paying firms. So we added free cash flow to it. So we said, okay, free cash flow, this makes perfect sense. This is an add-on to the Gordon growth model. However, we're still relying on that terminal value as a great driver of present value or market value. But now what we're saying is, all right, let's take a look at this from an economic profit standpoint. And so this adds even greater value. So look, we start with dividends, then we come up with free cash flow, then we do residual income. Look, as good financial analysts, we should all be running around our houses right now, high-fiving each other saying, hey, you know what? This makes perfect sense. I'm completing my knowledge so that, you ready for this? When we're that mosaic theory, when all this stuff is being forced into our ears and our brains and we're trying to process this as good financial analysts, these 3 models are going to help us identify whether a firm is fairly valued or not. All right, how about some relationship with the multiples that we just did in a previous reading? So look at that first arrow point. Residual income models can be used to estimate justified price multiples. Oh, this makes perfect sense here. So if ROE is greater than the required return on equity, which of course we have a green arrow upward, we want that, present value will be positive, market value will be greater than book value, and the justified price to book ratio will be greater than 1. Boy, there's a summary of what I've just been saying over the last, 5 or 10 minutes. And then, of course, we have the red arrow going down. We don't like any of those things. So let me just caution you as a test question creator. I love asking questions in which something bad happens. So you've got this vignette and something is good, and then something bad happens, and it can be summarized by the bottom portion of this slide deck. Notice this slide has two LOSs at the top. Calculate and interpret intrinsic value using the, all right, here we've done this before, single stage and multi-stage residual income models. And then let's go ahead and figure out how we're going to deal with something that happens at the end of the timeline. The reading calls this continuing residual income. All right, so there's our equation that is based on the Myron-Gordon growth model, right? So value today is equal to book value today plus some present value of what's going on in the future. We're assuming constant ROE and constant growth rate. We talked about that just a few moments ago. So let's suppose we have a couple of pieces of information down under the purple box: book value per share 44, return on equity 26, required return 17%, residual income growth. So this is just a pretty simple application of that equation at the top. So you can do the math quickly there and get a value of the firm residual income model of $110. Now, how about if we go from a single stage here? Let me go back here. This is just single stage, right? So we're assuming constant growth. We're assuming all this stuff goes from today all the way out to infinity. This is just a present value. I mean, think about this. This is really just a present value of a perpetual annuity, or a perpetuity, if you want to call it that. Now, remember that when we did Myron-Gordon and we did the free cash flow model, we said something like, hey, you know what? Let's go ahead and assume that this firm has super high growth rate for a relatively short period, right? We did like 1 or 2 stages of high growth. Well, this residual income model in the multi-stage part of this doesn't really say, hey, suppose that we have super growth for 2 or 3 years. All it says is, hey, let's estimate residual income because we can probably do it with a greater degree of accuracy in year 1 and 2 and 3 and maybe 4, probably not 5 or 6, but let's do that short time period. And then let's make some simple assumptions about what happens after that period. All right, so notice the first circle point. So we have forecasting residual income over a short-term horizon. Then making, boy, do I need to say this word, simplifying assumptions about growth over the long term. Now, what the reading does is it uses the term continuing residual income, but this is analogous to the terminal value that we did before. Residual income expected over the long term. So residual, couple of assumptions here. Residual income continues indefinitely at a positive level. That's important. What we could also do is assume that residual income is 0 from terminal year forward. I'm going to do that here in just a second. That's not too terribly realistic, but from a pedagogical standpoint, it makes sense to ask a question based on that orange assumption. We could also assume that residual income declines to 0 or it reverts to some mean level. So look for one of these following 4 assumptions at the end of that short-term period. And these really are not too terribly different from what we did back in the Myron-Gordon growth model. However, there's a little bit of differences in math that we have to do, and you'll see that here in just a second. Now, one of the ways to determine which of these 4 assumptions are going to be at play is to add another variable to the, let me go back to that model there. I could go back even further, but I won't. What we're going to do is we're going to add a variable. So if you look at that, value today is equal to book value plus, present value there plus something else. And notice that there's a funny looking W in there in the denominator. They call this the persistence factor. In other words, we're asking the question, all right, let's assume that we're estimating residual income for 3 years. And we estimate it, and I'll just make up some numbers here. We estimate 5 in year 1, 6 in year 2, and 7 in year 3. All right, so then, all the way out, we have a hard time giving accurate estimates in year 4 and 5 and 10 and 30. So let's just make some simplifying assumptions. So what we're going to do is we're going to look at that omega and say, all right, if it's 1, residual income will not decline at all, meaning that it stays constant, or that it's going to fall by some amount. In the extreme case, it just truncates. If it's 0, residual income will not persist after that initial forecast to rise. And you'll see that here in just a second. Notice that it will be between, the persistence factor has to be between 0 and 1. And so just trust me on the math of this, that 1 plus R minus W, the funny looking W over there, that is analogous to taking present value of a perpetual annuity. All right, look at the bottom table down there. If we have high return on equity, if we have extreme levels of non-recurring items, boy, we had an emphasis on non-recurring items in a previous reading. And so look for that term in the vignette, extreme levels of non-recurring items, and then automatically say, hey, that's going to result in lower residual income persistence, right? And then extreme levels of accounting accruals as well. So look at those bottom 3 on the bottom left. Those 3 will result in lower residual income persistences. But then what about high? If we have a high historical persistence in the industry or low dividend payout ratios, then that'll result in higher residual income persistence. The reading does mention a couple of sources, and I always find this stuff kind of fascinating. Somebody did some research, and I think they came up with an average persistence factor of around 0.62 for whatever sample that they did. All right, let's go ahead and take a look at a super quick example here. So what did we do before? Let's just remind ourselves. We had beginning book value of 9, and then we estimated residual income in years 1, 2, and 3, right? 253, 320, and 462. The return on equity was 8%, and that intrinsic value was 1775. So we want to do this again, assuming that the persistence factor is either A, 0, or B, 1. All right, so you ready for this? This part A in the upper gray box, we do all the math. All we're doing is taking a present value. So we do 9 plus the 253 plus the 320. Of course, we have to take present value of those in year 1 and year 2. And then we have to take the present value of that 462 going forward all the way. But with a persistence factor of 0, we're assuming, here, let me just go back here and remind you, where was this? Look at the orange block. The residual income is 0 from the terminal year forward, which, look at the answer, 1775. This is the answer that we got if the firm was going to liquidate after 3 years. Now we use this persistence factor model. We impose that same assumption by making the persistence factor 0, and we come up with that same 1775. So I want you to think about this. This 1775 is kind of like the minimum intrinsic value. That's what a persistence factor of 0 means. But then let's go to the other extreme. Let's suppose we say that persistence is 1. So all we do the same math. We put a 1 in the denominator and we get, oh my gosh, what is that number? $63.60. So we could have put together an Excel spreadsheet and done persistent factors of, 10 and 20 and 30 and 40 and 50, all the way up, every number between 0 and 1. And what would we have gotten? We would have gotten intrinsic values of the firm based on, present value of economic profits, residual income of between 1775 and 6360. So think of that 6360 as kind of like the maximum value of the firm. right, we can use that residual income model and do some pretty simple algebra and just rearrange that equation to solve for G. So look at that LOS. Calculate the implied growth rate given a bunch of stuff, right? So all we're doing is rearranging that so that we can solve for G. We call this implicit because G is part of the model. And when we move it over to the other side of the equal sign, then we're implying whatever that growth rate is based on those variables that can be observed. All right, let's go ahead and compute. Look at the LOS. It does say calculate. What is that implied growth rate given? Well, I think this is information from before. So current market price, we get $100. We substitute all that stuff in there, and we get 9.93% implied growth rate. Now, when I introduced this slide deck, I did say, look at that one LOS, compare residual income models to the dividend discount and free cash flow models, which is what I did at the beginning of the slide deck. And I feel like I've been emphasizing this throughout this entire slide deck. Let's go ahead and just work through this really cool arrow points going down. All right, so dividend and free cash flow models measure value by discounting a stream of expected cash flows. All right, so this makes sense. We've talked about this before. You know, the executives say to the shareholders, all right, look, you've given us a bunch of money. We're investing in positive net present value projects. Let's just compute the present value of dividends or free cash flow. All right, that makes perfect sense. But then look underneath it. They're very sensitive to terminal value. I've said this a couple of times already. Unlike the dividend, the residual income model, which is way less sensitive to terminal value. All right, so comparing, what are we doing? Stream of expected cash flows, but we're comparing that in residual income model to boy, do I want to say this, to economic profit, which is a function of things like, book value. So it's the present value of the expected stream of residual income. So remember that. You got cash flows over here with those first two models, residual income over here with this current model. Look at the bottom point we have down there. This is what I said to you. This is why it's so important to think of this as the end, almost the end of a series of 3 readings. Use a residual model alongside both of those models to evaluate the consistency of the results. Oh, that's beautiful. The Institute loves this LOS, strengths and weaknesses. So we've probably covered all of these during the course of this slide deck. Strengths, terminal value strengths for residual income. Terminal value does not dominate, uses readily available accounting data. We don't have to worry about non-dividend paying firms, and it can be used for firms that have 0 or negative free cash flows. And it's also a great substitute when those cash flows are unpredictable. I said this to you back in the dividend reading and also in the free cash flow reading, that remember that what we're trying to do is estimate the future, and sometimes free cash flow is pretty difficult to estimate. Focuses on economic profitability. And I love this because it goes back to Modigliani and Miller. Remember, these two dudes were economists because there was no discipline of finance. Back in 1958, they created it. So they love this concept of economic profitability. What don't we like about it? We don't like all the stuff that we talked about back in our FRA stuff. Accounting data is subject to manipulation, and we've got to throw in lots and lots of adjustments. What we automatically assume is that there's the cost of debt is equal to the interest expense. So what does that mean? That simply means that the bonds sell for par value. I mean, somewhere in that kind of assumption. And then this concept of a clean surplus then holds true throughout all of the estimate of those residual incomes. So when do we use this? Non-dividend paying firms, firms without free cash flows, when there is a high degree of uncertainty in forecasting terminal value. So let's get back to this clean surplus accounting, right? Beginning book value plus net income plus dividends. That gives us ending book value of equity. And so we don't want to use this model if, ROE and book values are from manipulated data, or they're super unpredictable because there's some great changes on the balance sheet, whether it's on the left-hand side or the right-hand side. Describe accounting issues. All right, so some accounting issues. We talked just a little bit about this clean surplus relationship. When the items bypass the income statements and direct adjustments to equity are made. And, the glaring example of this is those currency translations in the gains or losses. And this applies to all that stuff we talked about with forward contracts and futures contracts and option contracts and swap contracts. And then what about off-balance sheet items? Leases and deferred taxes and misstatements of book value. And then intangible assets always give us some kind of a problem. Non-recurring items, we mentioned that before. Aggressive accounting practices and international considerations. And here's this last super important one. When is the stock overvalued? When is the stock undervalued? When is the stock fairly valued? So, of course, we know those relationships, greater than or less than. This holds true for dividends, free cash flow, and now residual income models. And so I can't imagine putting together a vignette in which the last question, if there's 6 questions, if the last question isn't, okay, tell me about valuation, undervaluation, and overvaluation. And that takes us through these learning outcome statements. I like that first one there, right? Calculate and interpret. And I like that second to last one, calculate and interpret using single stage and multi-stage. And then I like the one of comparing this to dividends and free cash flows.